I'm always checking those two things, the emotional response, how I'm feeling, and the probabilities and my strategy.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
Welcome to Two Traders. It's Walter here. Hey, Darren, how are you today?
I'm very good, Walter.
So we're going to talk about this idea that we were talking about just before we hit the record button today, and this is you can tell if a trader is profitable by knowing blank. So the question basically is, what's the one thing you need to know about a trader to know how the trader is doing in terms of profitability? So do you want to take a crack at it, or do you want me to go first, or how do you want
the thing that struck me when I first read this this title for the podcast was, I thought about it for a while. What is the one element? And then I thought, well, you really shouldn't be concerned with whether other traders are profitable or not. And if you believe they are, then really you should do your own investigation to discover why you believe that to be true. So that was my first gut instinct to that question. And I know that's not really what you're angling at.
Right, yeah, right. I was kind of that's right. I mean, it's an interesting take. I was thinking more like you go to the doctor, and the doctor's like trying to figure out if you've torn your ACL. So that, they do this one test or whatever. And I was thinking of it in terms of a diagnostic. But yeah, I see what you're saying. Yeah, you're talking more about verification of traders or something like that. Like, should you put your faith in somebody?
Yeah, and again, I'd find that really hard to put a finger on, really, because in my experience, the most successful traders have always had edges in different places, and there's not really kind of one collective, one thing that seems to run true for all of them. I'm sure I know now you're going to come up with something and it's going to completely change my mind, but that's what I'm thinking at the moment.
Right. Yeah. No, I'm with you. Like, when I was thinking about this, I thought the same thing. I thought, well, hang on, I'd want to know this. And then I thought, no, I'd want to know that. And I said, well, actually, there's a few things. Like, it's kind of like when you go to the doctor and they ask you a few questions. They're not going to just say like, oh, does your knee feel, has it been swelling today? Yeah. Okay. Well, you've torn your ACL. Like, they don't say that, right? They say, jiggle it a little bit, and they see if it hurts when you do this, if it hurts you do that, and has it been swelling, and when you run, does it do this or whatever? There's a list of questions. But my idea, my thinking, and my thought, at least at this stage, is that if I know the likelihood of blowing up your account, so essentially, what is the risk of ruin for your trading system, or even if you combine all of your trading systems that you trade, and if you combine those together in sort of one master system, and you calculate your risk of ruin, which incorporates things like the average winner, the average loser, and the win rate, right? Those key parts of your strat and the risk per trade. If assuming, of course, that you have a constant risk per trade, which we know not everyone does, but assuming that that's what you do. If you have those elements, you can spit out at least two different ways a likelihood or a probability that you're gonna blow up your account, or you can change the risk of ruin formula so that it says, what's the likelihood that you're gonna have a 30% drawdown, right? Something like that. So to me, knowing your risk of ruin or your risk thing of X percentage drawdown, to me, that's the number one thing. And the reason why I think it's so critical is because nobody knows it. nobody ever looks at this. Maybe futures traders and maybe, well, certainly some people who get deep into risk, like private funds and things like that. They look at things like this because they're all looking at correlation and stuff. But most, at least my experience has been that most retail traders do not consider their risk of ruin. It's not even on the radar. And I would argue that that's the most important thing to know. Like, what is the risk of ruin? And when I say risk of ruin, I also mean risk of X percent drawdown. Like, if you, Darren, as a trader, say, you know what, if I have a 35% drawdown, I'm going to seriously consider stopping trading this system or stopping trading this market or whatever, your red flag level is. And I can say, well, Darren, you've got a 17% chance of hitting that over the next 1,000 trades or what. If I had, that's a really important piece of information. So I would go with that if I had to, lock in one thing. And what's nice about it, like I said, it incorporates a lot of different elements of your strategy or strategies if you trade several strategies.
Yeah, I think what you say is completely true, and I think best advice in a way to approach trading is from that standpoint. You really want to limit the possibilities of you blowing up as much as possible while still having good probability of making profit over the long term, and that really is the best advice about how to trade. But there is a lot of traders who have been really successful and have basically not taken that into account. And the most obvious one that people will probably know is in the film Margin Call, the trader there that was betting against the housing, the mortgage defaults, and his risk of ruin was massive there, but he was right, and his payoff was massive, and he made a lot of money. So you could also argue that he was super successful trader. And, obviously that is a much more risky approach. But it does go to show that, there's more than one way to skin the cat here, and you really need to decide what you want to get out of trading. If you want to make a fairly safe, fairly low risk income over a long time, then a certain approach you should adopt. But that isn't necessarily right for everyone.
Yeah, that's right. Yeah. And, there are stories out there like Jesse Livermore apparently, he had some wild swings where he went broke and then he made millions and then he went broke and then he made millions and then he killed himself, and there's George, that's another, and George Soros, right? I mean, apparently George Soros did the same thing with the Bank of England trade, right? Where he had I think it was the Deutschmark, the Deutschmark against the pound, and he basically broke the Bank of England. That's the legend. And he says, it takes courage to be a pig. So to me, that's like code for, I really bet the house on that one. You know what I mean? So, it happens. It definitely happens. And I think that would make for a really interesting podcast. Maybe we can do that in the future where we talk about that approach to trading. Like how can you wall off that approach to trading and use that in your trading? But from your point of view, because there's sort of two questions here. The first question was the one that I was thinking of, which was, what do you do or what do you want to know in order to make sure that you're on the right track as a trader? And I would argue that's your risk of ruin or your risk of X percentage drawdown, and fill in the blank with the X percentage, right? But like your initial thoughts here were interesting to me because I think you're right. Like you don't really, what's the point? Why is it so critical for you to know about what another trader is doing or what another trader is capable of, particularly when we know, or at least I would argue, I have a strong belief that it doesn't matter. I don't give a rat's behind how Darren trades or how Darren finds his profits, because I know I can't trade that way. Do you know what I mean? And it's the same with any guru. Like any guru out there who says, look, this is how I trade. I don't think you should follow that guru. I think it makes sense to learn elements and maybe pieces, or even just to look at that and go, nope, not for me. Even that's useful, just knowing that that's not for you. But I don't think anyone listening to this podcast, if you have in your head this idea that you're going to follow a guru and path to riches, I think you're going to be sorely disappointed.
Yeah, totally agree. And I think, for me, more than risk of ruin, I kind of like to look at it in a way of your risk and your losses are always related to your possible gains. And if you want really, really small drawdowns and really small risk, then that is going to have an effect on the sort of profit that you can make, unless you get perfect market conditions for your particular strategy. And that is the least likely thing to happen, that it's always going to be the perfect market conditions for your strategy. So, you kind of have to temper both sides. And if your desire as a trader is to make a lot of money quickly, then you're going to have to take on more risk. And those two, to me, are always locked. And I think a lot of traders try and unlock that. They want their cake and they want to eat it. They want really small drawdowns. They don't want to take much risk on, but they expect really big returns. And I think, that's a really important distinction to make.
Yep, absolutely. Yeah, I think, that's the big draw to me, that's the big draw for those martingale systems, right? People just, they feel like, it just feels like they're not really risking anything because they just keep winning and winning and winning until they don't. Yeah, I think that's right.
Yeah, I mean, they're taking on a lot of risk to get a lot of gains, but the gains tend to be small wins often, and you need to decide where you kind of want to sit on that pendulum, whether, how much risk you really want to take on. That's why I think it's always dangerous for people to sort of, say drawdown should only be a maximum of X percent, a really low amount. That's fine, but you've got to accept that is going to affect your upside as well.
Yeah. So my question for you then is, where's the sweet spot there? And I'm talking in general terms, I'm not talking specific. So, for example, let's say that I'm one of those traders that says, I want, for example, common thing is I want my returns to be double my drawdown. So if I have a 10% drawdown, I want to be able to try and, shoot for those 20% returns or whatever like that. So the question is, where should the focus be then? What do they focus on?
I think that the focus should be on how much you're prepared to risk, how much you want to lose, and then how you personally feel about it, I suppose. I mean, I know I'm always going on about Dung Capital. They have drawdowns of 20%, 40%. Doesn't seem to bother them, and they make money over the long run. And when their gains, when the markets play as they want them to, they make huge gains. And that's something that they're happy with. And he blanket says to all of his investors that he trades for, he says, this is how I trade. If you don't like it, then don't put your money with me. And I always bring him up because he's a really good example that you can be successful with slightly larger drawdowns. The reason he makes it works is when his trades do come off, the wins are massive. But he has losing years. He has years where he makes no profit all year. So you really need to decide where you're comfortable and how you want to trade.
Yeah. Do you think that the exits are really kind of the the area to focus on? Like, if I'm a trader and I say, look, I'm back and forth. I've got like 15% drawdowns but my returns are only maxing out around 15-17% too. What can I do here? I would say probably look at your exits, but I don't know. I mean, what would you say? Because I'm just talking like abstract here. If we look at trading as like, your trade results as the bell curve, right? And on the left of the bell curve, you have all those losing trades. And then on the right of that bell curve, you have your winning trades. And you have a few really bad losers on the far left and a few really good winners on the far right. If you have a stop loss, in theory, what you're doing is you're slicing off that bad, and I'll put an image in the show notes so you guys can see. I have a video on this because I think it's a useful way to look at it. Well, if you're using a stop loss, then in theory, you should be cutting off most of those. You can always get slipped and gapped and all that, but you're cutting off most of those really bad losers. And if you have some sort of a open or trailing exit or way of getting out of your trades, then in theory you should capture more of those extreme winners on the far right hand side of the curve. So to me, that's where the that's where the value is. But I wonder what you think about that.
Well, I certainly believe that. I mean, everything that I've read on the subject, in all my study, as far as I can see, if you can make sure that you have a higher risk to reward, then your probabilities of making profit over the long run tend to be higher. And I know a lot of people will disagree with that, but all the facts point to that it's a case of we let our losers go too far, and we don't let our winners go further enough.
So would you say that's the one thing then, like getting back to the question, if you can tell a trader is profitable by knowing his risk to reward ratio, would you say that's like, would you say that? That was one of my original thoughts, was that. And then before I decided to go with risk of ruin.
Yeah, so I mean, certainly, if I saw a trader with a 1-to-1 risk to reward and a profitable, say profitable year, and I saw a trader who averaged 3-to-1 risk to reward, and I had to bet on either trader to do well next year, it'd be the one with the higher risk to reward. I'd be quite impressed if I saw someone with an average risk to reward of 3-to-1 over a year. That would impress me.
But what if that trader only took 5 trades last year?
Or more. Well, yeah, certainly trade frequency will definitely come into it. Yeah, that is a factor as well. And that's part of, like you were saying, the risk of ruin, that's one of the important elements in that calculation. So it is important.
Yeah, having more samples. So like that's the thing. Like people say they want this system. They want this system that has a 3 R, so 3 R average winner, and 77% win rate and all that. And I say, well, that there aren't very many of those out there, and the ones that I've seen, they don't trade very frequently at all. So it's sort of like they pop up every once in a while like a unicorn, and then they're gone again. So I don't know. That's the tricky thing. And if you were to use some sort of optimal F or some sort of derivative of an optimal F, and you had such a system that had a 3R, for example, so the average winner was 300% bigger than the average loser, and it won, let's say, 77% of the time. If you're using some sort of optimal F calculation for your position sizing, I mean, you'd almost be required to bet the house, like to bet a huge chunk of your account on that type of strategy, which of course means that you're going to have massive drawdowns. So it's most traders can't deal with that, and that's why I keep coming back to the risk of ruin and the risk of drawdown as the key thing. From what I see, traders quit or change the game, change the system from going through drawdowns. Like it's the special trader that's able to trade out of those drawdowns. Like that's the and that comes all down to the psychology. And I know we spent for the listener out there, we spent a lot of time talking about psychology, and I think in some ways what we talk about, Darren, is probably not going to be that interesting to new traders, and probably much more interesting to experienced traders, because it always seems to come back to psychology. But that's really what it comes down to, is the experienced trader is working on himself or herself. He's working on psychology, and he's able to get through those drawdowns. The inexperienced trader doesn't understand the risk of ruin or the math or all that stuff, all that stuff involved in trading, and isn't able to rely on psychology, whatever psychology techniques or tricks or beliefs you have, isn't really able to rely on those and pull out of that drawdown and come out on the other side.
Yeah, I agree, and I liked what the fact that when we talk about risk to reward, you should always think about it as average risk to reward, because I think setting a fixed target on all your trades is really inefficient, and it tends to make less profit. So you should be looking to average over a certain amount of risk to reward, but not expecting all of your trades to exit right on that mark. I've seen a lot of tests with random entries where a trailing stop, so your maybe your average risk to reward is 3-to-1, but within that you have some trades that are 7-to-1, 8-to-1, 10-to-1, and a lot of trades that are only 2-to-1 and 1-to-1 as well. In my experience, that kind of approach is more profitable.
Yep. But I know we talked about this a long time ago in one of the earlier episodes about, setting a weekly target. So I wonder, I'd just love to get your thoughts on that, because it's related to what you just said, which is, if you have a hard target with your trades and you're not as flexible, you're going to miss out on something there. And I think if I recall right, we were talking about this, and I kind of had the same angle in my thinking in terms of, weekly targets. Like, I think the question was in that podcast something like, should you just shoot for X number of pips a week or X return a week. And I thought that was a bad idea, because what that meant was you would average lower than that. You know what I mean? Because you're going to have those down weeks, and that's going to pull your average down. So, on the other side of that is, if you make your money on Wednesday, there's a chance that you're going to give it back on Thursday and Friday. You know what I mean? So what do you do? Crazy thing, right?
Yeah, and it's actually a bit of an illusion, and really all you're doing is you're just saying, look, I've done well, I'm feeling good about it. The dread of it going pear-shaped now is so much that I'm just going to go and sit and in my happy place and enjoy it. But the facts are, and I've been down this wormhole, is that you actually perform worse if you set targets like a weekly target and a monthly target. And I did a lot of testing on this, and all my tests came out that if you'd have continued trading, you would have done better than if you stopped at a specific target. And of course you go down maybe the target's wrong. And I went down that well, and we tested all the different targets, and the results kept coming out that you would have just been better trading your system in the way your system's supposed to be traded.
Yeah, okay, that's very interesting. I have a theory on that, and I'd love to get your thought on this. I believe that the reason why we want to take that break is we've just spent so much emotional or psychological energy on these trades and rolling through we just pulled off the roller coaster, and we don't want to get back on again, right? I mean, that's why I think we want to give ourselves a reason to rest, basically. What do you think?
Yeah, it's fear of future regret, isn't it? You're in a good place now, and there's a possibility that you're going to have to give some of that back. Highly likely you're going to give some of it back, and you might give it all back, and yeah, it's a really destructive emotion in trading. And the best thing to do is test it. Test it over a long, over a large sample with a lot of instruments, and see if your belief that you're better off stopping at a certain target is true or not. And I think you'll find that it's not. But I totally understand it, and it's not to say that you can never do it. I mean, if you get to Thursday and you've had a great week, then there's no real harm in taking a break. There's never any harm in taking a break from trading, especially when your emotions are heightened. There is no harm in that. Get yourself back to a level and then continue trading. But specifically setting a fixed target is a less efficient way to trade.
Yeah. That makes a lot of sense. Yeah.
It feels great. I know it feels great. And there'll always be exceptions to that. If the market is suddenly, after a really strong move, perhaps looking like it's going to consolidate, then you can make your analysis on that. And if that is part of your system, then certainly you can do that. Yeah,
I mean, I think there's a couple of issues here. One is the question that you've tested, which is, should I have a target and just stop trading, or should I just keep trading through it? And the other question is, is it a good idea? Is it a good idea to keep trading even though I'm totally completely frazzled, mentally, which of course we both agree, obviously, no, it's a good idea to take a break, whatever. It's just like back testing. If I'm in Forex Tester for 4 hours, I can guarantee you that the last 20 trades I take are not nearly as good as the first 20 trades I took. And that's regardless of whether they worked out or not. I don't care. I'm talking about execution. Execution is the thing that I've been spending a lot of time the last couple of years focusing on, and not so much the other stuff. But that's beside the point. The point is, if you're getting sloppy, that can happen because of, emotional issues or psychological issues. You're getting too confident or too down in the dumps because you're in a drawdown or whatever. And that might mean that, yeah, it's a good idea to take a break and step aside, just like it's a good idea to spend 30 or 40 minutes in Forex Tester at a time instead of, 3 or 4 days and sit there in a dark corner and, I don't know how many people have done this. I don't know if it's just my own little private joke, but you're ordering pizzas and you're your body is conforming to the chair and you're just sitting there testing the system because you're absolutely convinced that this is this is going to be the next big thing, right? And you just and then you get up and it just, those days are done. I'd rather just have small, quick hits of testing rather than spending all that time just kind of conforming to the chair. It's no fun for me.
Yeah. And you need to, you're always having to keep in mind two things, I think, with trading. One is your system's probabilities, okay? And, that is built up from testing and understanding your system and, how the drawdowns are likely to come and the winning streaks are likely to come. And you build your strategy around that to, minimize your risk and try and maximize your gains. And then the other side of trading is in the moment, the execution and the emotions. And whenever you're trading, you need to be aware of those two things. And if you start trading, I started trading this morning, I took 4 consecutive losses. Now my emotional response to that is I want to stop trading because it's painful, and I was actually in a nice gain before it reversed and all went pear-shaped. But at the same time, I know that the probabilities are that this happens, and if I keep trading the system, then the next time or whenever, it's going to continue to run in my way, and that's where I'll make my profit. And over the long run, that's what's going to make me profitable. So I'm always checking those two things: the emotional response, how I'm feeling, and the probabilities and my strategy.
Is it to me though? That's the core of trading. What you just said, like that is it. That's it. That's the game. And it's so funny because if you would ask me 15 years ago, I wouldn't. Those two things wouldn't have even been on my radar. Like, it was like, do you know what I mean? Like I would have been looking at the Gann square of 9 or whatever, going, I'm going to figure out how Venus is related to the euro or whatever, and like, it's just so funny. It's just so funny that how things change and how you get, as you mature as a trader, that it becomes more about those two things.
Yeah. And I did a post on the forum a while back about drawdown, and the fact that I feel that it's always going to be more severe and more extreme than you plan or think it's going to be. And I think you kind of need to go with that mindset. And coming back to the question where we say, what one thing is going to convince you that trader is profitable. And again, I don't think you can generalize too much, and I see a lot of traders do it. Like you were saying earlier, they come out with like blanket statements: I want a max drawdown of 7%, I want to make 35% a year, and they seem to want to control the outcome of their trading. And I think you're much better positioned to approach it where you have very little control, and you really need to pinpoint the exact elements that you do have control over. And I see a lot of traders presuming that they can control all of the elements, and I think it's a bad mindset for trading.
Yeah, that's right. Yeah, I mean, it sounds so cliche, but that's what you hear like athletes talk about. I only concentrate on what I can control, and that it's the same in trading. You're going to be faced with these issues, which are basically, you have this fear of failure. These things pop up when you have rough patches, but really it comes down to focusing on what you can affect, what you can adjust to, and what you're in control of, and all the rest of it you have to just learn to let go. That's the critical part here. So, all right. So to wrap up on this, Darren, I'm going to say, I'm going to go with the, the risk of ruin is the thing that I would, if I had to hang my hat on one thing to decide on how a trader is going to do or is doing, it would be the risk of ruin or the risk of drawdown for that trader's systems. And we both agree that probably doesn't make a whole lot of sense to try and, trying to justify or verify what's, knowing that you're going to trade your beliefs anyway. It doesn't really make a whole lot of sense trying to figure, and even though so-and-so is doing X this or X that or whatever, I mean, it's really what it comes down to is you. And even though we sometimes get sucked into systems because we think a trader is really good or the system is really great, the fact is we're never going to trade it the same way that other trader does. We just won't. It's just not going to happen because we trade our own beliefs. So that's another thing to be aware of. So any closing thoughts on your end?
I'm going to have to go with what you said, really, Walter. I think the best advice is to look at risk of ruin. I think it's probably the most important calculation that you can make, and like you say, a lot of people do not look at it.
All right, guys. Thanks for spending time here with us, and we will see you in the next episode. Thanks a lot, Darren. We'll see you next time.
Okay, see you next week, Walter.